Welcome back to America's Commercial Real Estate Show. I'm Michael Bull. Thank you for being with us. This segment is brought to you by GetValuate.com. Check it out. It's a really cool online investment analysis program you can share with colleagues online. Well, today we're talking about self-storage and what a great property type. It's really grown in popularity with institutional investors and with all investors across the country. But where are we in the cycle? What are some of the economic influences that impact self-storage? Well, we have another expert on our show today. Please welcome, it's Cory Sylvester, and he's a principal with Union RealTime. And Cory is joining us on Skype this morning. Thanks for being with us.
Thanks for having me, Michael.
So let's talk about the performance overall. You guys do a great job of tracking performance on the self-storage properties. So how are they performing overall around the country?
Overall, across the country, we're definitely starting to see a slowdown in the leading metrics for most of the major areas, and occupancies are seasonal, but we are seeing them decrease slowly year over year, and pricing in some areas is off significantly. I think that has mostly to do with that we are in the fifth inning of a pretty significant, I'd say unprecedented development cycle. So the metrics are definitely slowing, but in terms of the core business, it's still a fabulous business to be in. You just have to be very knowledgeable about what area you're either buying or building in at this point, because there's a lot of activity out there.
Yeah, and that sector, self-storage sector, has really had a lot of growth over the last several years, right? So is this kind of slowdown in the improvement in the numbers something relatively recent?
Relatively recent, I would say within the last 18 to 24 months. You had a period after the 2009 recession where essentially no self-storage was being built across the country. So fundamentals in the industry in terms of occupancies and rents got to rather unprecedented levels, and that has caused a pretty significant amount of development activity that started about 3 years ago. And so the softness has really started to show through in the last 18 months as some of those new properties have been coming online, and you're starting to see a little bit more softness as new facilities are competing for new tenants.
Right, and it seems like there's not, in some markets, not a big barrier to entry in self-storage. Obviously, getting New York where you are, or in the center of Atlanta where I am, there's some barriers to entry, but in some sub-markets and smaller markets, there's not. So what do you expect for new supply moving forward, and how might that impact performance of existing properties moving forward?
Yeah, new supply going forward, well, a lot of it is in terms of activity that's already underway. So for this year, I'd say if we're talking straight numbers, in 2017, we saw supply grow in the top 50 markets at just under 4%. And if you talk specifically at the whole U.S., it was about 3%. As we look into 2018, so we track deliveries in real time with our technology, and what we have seen makes us think that deliveries in 2018 are going to be higher than 17, so probably 4.5, 4.6%. 2019 is a little hard to call at this point, but there's still a lot of development activity going on. The incentives to develop are still very real. So we don't think it's going to fall off a cliff. So in terms of what activity is going to happen going forward, still a lot of deliveries occurring, and don't see a ton of evidence at this point that it's going to end anytime soon.
And what might that do to occupancy levels and rental rate levels moving forward?
Obviously, it's a function of where you're at, right? So in Denver, you're talking about 28% potential supply growth over the next 12 to 18 months, depending on if all these projects convert. That's a lot of supply to be added to any market, even though Denver has been growing like gangbusters from a population and job growth standpoint. But definitely from a national level, the way that we think about it is that occupancies are continue to decline year over year, and pricing likely will continue to be under pressure, and see the same sort of trajectory.
Okay. And what is that doing to cap rates around the country? What do you see for trends on cap rates for self-storage properties?
Cap rates, that's an interesting question, because there's two different cap rates that you should think about. Cap rates for existing properties, which are, call it 5 to 6%, depending upon what region and property you're talking about. Those cap rates are likely going to stay pretty steady, may increase slightly. The problem you have is that fundamentals are starting to roll over a little bit in the industry. But sellers are really not recognizing the amount of supply that's occurring nationally, and kind of that environment that it's creating, making the acquirers less aggressive than they were. So there's still a little mismatch between expectations and reality. But at the same time, you still have an enormous amount of private equity capital, a lot of other sources of capital in this cycle that are still pushing to buy facilities. So on the other end of it, even though you have softness, you still have a lot of aggressive buyers out there. So, cap rates may rise slightly, but there's still too much capital going after these properties for them to really raise too much over the next 12 months, in our view.
Okay, and we talk with Cory Sylvester, and he's with Union RealTime about self-storage properties. So, Cory, what else is on the minds of the self-storage industry? What could impact the industry moving forward, either positively or negatively?
Yeah, I mean, it all comes down to development activity, and what ultimately impacts development activity, or is the leading, or the factor that's driving development activity, is where do developers think they can develop to? So the current market is trading, cap rates are at 5 or 6%. Developers today think that for the most part they can build to a 8 or 9 cap, and you only need about 150 basis point difference between those two numbers for developers to continue to want to develop. So the biggest factor in terms of what impacts this industry is when developers start to recognize that rental rates are coming down, occupancies are coming down, and perhaps instead of building to an 8 cap or a 9 cap, you may be only building to a 7 cap, and at that point then it becomes less interesting to build, at which point then we move into more of a cycle where acquisition becomes more the preferred route for capital, which will lower the amount of supply coming on the market, and the fundamentals should increase at that point. So figuring out when that inflection happens is an important decider for the industry, and when that happens is just a function of when developers really think the incentives aren't robust enough to continue to try and develop.
And Cory, what would you say to the audience that maybe hasn't invested in self-storage before, or they've not developed it, that they might want to think about it in that industry? So I think some people like it when they think about it. Maybe they own multifamily and they don't have the tenants, they don't have the bathrooms, they don't have the kitchens. Maybe they're an office, they don't have these huge build-out costs and leasing commissions. What should they think about?
If you're a new entrant in the self-storage business, it's really about doing the proper due diligence as you're underwriting whether you're building or you're buying. And a lot of that has to do with understanding the dynamics of supply and demand. So are there new facilities going up in the area? And if there are, how should I incorporate those into my analysis of whether I want to be in the self-storage industry? Long term, I mean, it is a fabulous business. The return on invested capital can be very high. So, the margins in self-storage are phenomenal. But again, if you're coming into the cycle at this point, it's really just about making sure that you're fully educated about all the different aspects of what's going on, because it's a very, very dynamic market right now. So, you really need to be conscious of the data, understanding where pricing is today, where it can go in the next 12 to 18 to 24 months. And that's a function of understanding, are there new facilities out there? Are there facilities that just opened? because they take 2 to 3 years to fill up, so they're going to be pressuring rates in your area. So it's really just understanding your local area in a very, very detailed way, and that's something that we help developers and the industry with.
Well, Cory, thanks for joining us. Great information.
Absolutely. Thanks for having me.
If you like more information, check them out, Union RealTime. They track the market. And next, we're going to talk to a participant that is talking with buyers and sellers every day in the self-storage market. Don't miss it. Stay with us. I'm Michael Bull. This is America's Commercial Real Estate Show.